Hi, this is Stu Stover again. One of the interesting topics in economics, and this one actually goes both ways, micro, macro, although we tend to cover the Federal Reserve in macro because we have divided some of the government policies between fiscal policy, which is what the Congress does, is they allocate funds for programs, and whether we're trying to stimulate the country or we're trying to cut back on spending for any number of reasons, or monetary policy. So now we're talking about the monetary policy issues that show up in America. In America or anywhere in the world? And the answer is anywhere in the world. And so we call it a Federal Reserve. Most countries call it a central bank. So let's go back and do a little history on the central bank and what we call Federal Reserve in America. And to do that, we got to go back to 1907, 1908. America has suffered through numerous depressions. And so the Great Depression of the late 1920s, early 30s, into the late 30s was horrible. It was awful. Just the astonishing consequences of the Great Depression, but that wasn't the first one. We had one in the 1870s, we had one in the 1890s, and then we had one that was sort of emerging in 1907, 1908. Okay, so the background is we had a banker, and he was not unusual. He was a normal banker in New York City, where was center of banking, New York City. So a lot of this stuff is based around what happened in New York City in particularly early 1900s, whatever, and late 1800s. And so this guy was the president of a bank called the Knickerbocker Bank. He decided that he was going to use investor money, so people who had put their money in the bank, in a savings account, he was going to take their money and invest it in Wall Street and try and do something called cornering copper. Okay, so when you corner copper, could be gold, it could be, pick a commodity, it doesn't matter. This one happened to be copper. He wanted to buy up enough of the copper that he could control enough that he could force the price up, make a pile of money. What a deal. So he attempted to do that using not his money, but investor monies in his bank, which in today's terms would be terrible, awful. You go to jail immediately for stuff like that. But in those days, there were no laws against doing something like that. There were previous examples of cornering the market in gold in the 1850s, 60s, 70s, and other commodities along the way. Most of them fail because it's hard to have enough amount of, in this case, copper to actually force the price up or down with that process. So what happened, this guy at the Knickerbocker Bank, he failed. He couldn't pull it off. And in fact, the price of copper plummeted. Okay, so what happens in America? At that point, the bank's in trouble. They have lost a lot of people's money. And the normal response when people find that out, they do what's called a run on a bank. And what do? They're concerned their bank's going to close up because there are no regulations that would prohibit a bank from just closing their doors and everybody losing their money. Too bad. Oh well. That was a laissez-faire banking system where there were no regulations on that process, or very, very limited regulations. And so what do people do? They immediately go, I got to go get my money. I got to get my money. And so they line up at the bank to try and get their money back. And in those days, it was in gold. Well, how much gold do you suppose the Knickerbocker Bank had in the bank before they went, yep, doors are closed, anybody who's in line, go away, maybe we'll have some gold tomorrow. There was no Federal Reserve that would back that. There was no federal government that had any guarantees on that stuff. And so what happens is once the first bank starts to tumble, this is like dominoes, guys, then other banks start to tumble because other investors in other banks are going, wait a minute, my buddy over there lost his money at Knickerbocker Bank. I better get my money. And pretty soon, there's lines at every bank. Is that bad? That is horribly bad. And in most cases, there was no reason for it, but it's kind of a natural human reaction to the risk of all their money just sort of pooping off into the air. So what was going on here is the bank's failing. And actually, it didn't fail. It was actually a pretty good bank, and it came back eventually. But because of the stress it put on the entire American banking system, J.P. Morgan, who was one of the robber barons, stepped in, gathered his buddies, and they decided which banks were worth saving and which ones they were willing to let go. Ooh. So all of a sudden a whole lot of people are having decisions made for them about their life savings by one guy. Now actually he's a good guy. He's not a bad guy. He was trying to save the system. We'd also talk about the problem of the banking system of 1907-1908 in America as basically an agrarian banking system. So it was set up for agriculture and small farms. Is that what we had in 1907-1908? The Industrial Revolution had kicked into gear in significant ways. The world of banking had fundamentally changed, and the needs for the banking system had fundamentally changed. So he got together after the event was sort of tamped down, and we kind of moved on. We didn't have the crisis that we could have had. And he said we can't rely on one individual to save the economy. One individual to save the American economy? That's just nuts to think about it in such terms. And so he got together with a number of other significant financier types, and they went to someplace, Duck Island or Jekyll Island or wherever it was, and set up a system for creating the Federal Reserve. Okay, so the Federal Reserve was actually not created until 1914. Well, 1914, Europe is in the midst of starting World War I and all sorts of economic crisis around the world. And so we were trying to create a system. So what's the Federal Reserve fundamentally for? Okay, and again, I'll probably do a second video on this to talk about some of these issues in more detail, but they were there to backstop the system. Okay, so if there's a run on a bank today, and it happens, a bank closes periodically, we have a couple banks a month that close. We have a system for taking care of banks today that close for whatever reason. And so what would happen if there's a run on the bank? You call the Federal Reserve. The Federal Reserve loads up some money, takes it, drops it off to the bank, crisis solved. Oh, is that much better than relying on JP to step up and try and figure out something? Sure. So it was a systemic solution to the problem, not just a knee-jerk reaction in which banks do we save or not, whatever. So number one is they provide that backstopping. So a lender of last resort, an essential piece of what we got to have in a modern banking system is to have that. Now still, we didn't have any of the deposit protection that showed up in the 1930s, and so still investors could get fleeced in all sorts of ways up until you had those federal protections showed up later. But at least you had some system for keeping banks in play. Okay, that's number one. Now, as time has moved on, the Federal Reserve manages the price of gold. So it's a quirky one. Great Depression time. Great Depression time, you had a bunch of countries, primarily Europe, that had dropped their gold in American banks. Great Depression starts, what do they want to do? They want to take the gold home. And so our money system was based on how much gold we had in the country. Would that have been a huge problem to have all that gold flee the country? You bet. So as the Great Depression was starting, the Federal Reserve actually raised interest rates. So that's protected the gold from fleeing back to Europe or wherever else. But what did it do to normal consumers? It was like throwing gasoline on that fire for consumers and just exacerbated the problem of the Great Depression. So gold was a critical issue for them to manage. Today's terms, we talk about inflation and unemployment as the two big issues that the Federal Reserve would manage today. Now, there's a ton more that they do, and we're going to talk about a little about that when we get into the Great Recession. And the Great Recession was a critical juncture for the Federal Reserve. And so there's a reason we're going to focus on that. It wasn't that long ago that actually happened to us. So the Federal Reserve has become a fascinating piece of our economic stability in America today. And they provide a key role to keep the system reasonably stable. Not that there can't be fluctuations and other kinds of things. But right now, Federal Reserve is called a quasi-governmental agency. Okay, quasi is kind of one of those odd terms. It means they're kind of part of the federal government, but they're kind of independent. And so there's a number of folks who want to bring the Federal Reserve into more of a central bank notion, that it's part of the executive branch. Now, my fears on that one, and not just mine, but lots of people, is that then it becomes a political entity, and it's serving the needs of whoever happens to be sitting in the president's office. Where right now, they can focus on the long-term good of the country, not just focusing on the short-term stuff. And I could give you a bunch of examples of why there's potential huge risk by bringing that into a more political process, as some people are talking about today. But the idea was not to have this political, to have them have a degree of independence so they could do what was good for the American economy. It didn't always work out. There's lots of problems with that. But in general, it has been a great system for us. Thank you.